Good afternoon, everybody. So I hope that you started to settle down and everything become clear to you. So for lecture 2, we will talk about the accounting equation, double entry system, and the trial balance. So let's start now with the accounting equation. The accounting equation, which you should remember as your name, is assets equal liability plus equity, or assets minus liabilities equal owner's equity. Now let's have a look at the accounting equation here. The accounting equation, there are some rules for the accounting equation. The first one, that should be in balance. Second, if there is an increase to the left side, so automatically should also an increase on the right side. But not always the case. Sometimes could be increase on the left side and could be decrease on the right side, and vice versa. It depends. We'll come to it in a bit. So for 30 seconds, have a look at this balance sheet. Balance sheet consists of assets, liabilities, and equity. This is the old version of balance sheet, or we call it a statement of financial position. And we start with, as you see, from non-current assets or fixed assets, because assets is divided into two parts. We'll come to it in a bit. And we've got the current assets. So fixed assets, as you see here, okay, fixed assets or non-current assets. Assets are used by the business for more than 1 year, such as you see, premises, vehicles, fixtures, and fittings. Also, another type of assets for less than 1 year, current assets. And current assets such as inventory, stock, what the business has, trade receivables, or we call it debtors, we'll come to it in a bit, and we have cash in hand, cash or bank. In terms of liabilities, also we have two parts here, which is the current liabilities. It's liabilities, obligations on the business for less than 1 year, such as you see, trade payable, creditors. We'll come to it in a bit. I'll explain it, don't worry. Also, we have bank overdraft. This is when your bank balance becomes minus. And also we have tax could be, tax could be for the business, corporation tax could be for 1 year, less than 1 year. It all depends. Could be sometimes for more than 1 year. So it all depends. But net current assets equal total current assets, which is 7,250 minus total current liabilities 5,000. So that's what's the total current liabilities? 1,500 plus 750. So that will come to net current assets 5,000. So another type of liability is long-term liability. Long-term liabilities is obligations on the business for more than 1 year. Think about it, that a typical example would be the bank loan, because usually most of the time the bank loan lasts for more than 1 year. But of course there is short-term bank loan, of course. So net assets equal total assets, okay, total assets, which is 132,000 plus 7,250 minus total liabilities, which is the total current liabilities, 2,250 plus 5,000. So that comes to net assets. Net assets. This is the first part of the accounting equation. Assets assets minus liabilities equal equity. Equity is the one on the below here, financed by, or we call it equity, or financed by is the capital. You start with the capital, you add profit, how much you made profit or the company made profit, and also you need to list the drawings. So 77,000 is equal 77,000 here, and this is what we call the accounting equation is balanced. Again, we'll come in details in a bit. So let's have a look at assets. I explained assets, but again, to recap, we did say that assets is divided into non-current assets, or we call it fixed assets, and we did say that fixed assets or non-current assets items will be kept for more than 1 year in the business, and it's used by the business. This is for the business use, it's not for resale, such as buildings, machinery, etc., vehicles, computers, laptops. Also, we have the current assets, and we did say that items will be used within 1 year. But if you remember, such as if you remember, examples would be the inventory, which is stock, receivables, debtors, and also will be bank and cash. Let's come to liabilities. Again, we did explain it, but again, to recap, current liabilities, money that is owed by the business that will be paid, we did say within 12 months. And we did say example such as a trade payable and also the bank overdraft. And also we did say about the long-term liability, and that we did say that the money owed by the company that should be repaid within or not within after 1 year. So, and we did say an example would be the bank loan. So now remember something. There is something called shift in assets, right? What do I mean by shift in assets? Shift in assets means that occurs when the composition of the assets has changed, but the total will be the same. What does that mean? Okay, let me give you an example. First of all, you need to know that assets, what the business owns or control. Anything the business owns is called assets, isn't it? An example of assets would be cash or bank cash. The business has cash, they own cash, it's an asset. Also, the business has inventory, has a stock. Again, it's an asset. So now, remember, if the business bought inventory on cash, right? So what happened in cash? In cash goes down, yeah, because they paid in cash, isn't it? So that means assets goes down. What happened in the inventory? Inventory goes up because they bought inventory. True? In this case, what happened in assets? Assets goes up. And that means that composition has changed, but the total assets is still the same, because £100 more and £100 less, but the total assets is the same. This is an example in shift in assets. So now, as I did say, that we have two terms here. These are important terms, and a lot of students got confused about them. But remember, what is the difference between trade receivable and trade payable? Trade receivable, an asset that indicate amount owed by a customer. What does that mean, right? One example. When you go and buy laptop, £1,000, okay? So a lot of companies, they offer, such as Apple actually, they offer installments. True? So what does that mean? This means you pay every month. £200 or £100 every month through installments. So you are a debtor to Apple, right? So Apple has a trade receivables of £1,000. Why? Because Apple sold £1,000 laptop, right? But they haven't received cash. So they sold it on a credit. So it means sales are made on credit. Again, I'm repeating myself. Sales are made on a credit. That will indicate trade receivables there. When you pay back the money, so the trade receivables will be less. Trade payable is different, or not different, is the opposite, right? So we did say sales are made on a credit is related to trade receivables. The opposite, we say purchases are made on a credit is to do with trade payable. I'm talking about the business, isn't it? So think about it now. If Tesco bought banana from X supplier, right? But they haven't paid them in cash. They bought bananas on a credit. So Tesco bought banana on a credit, isn't it? Right? So in this case, the X supplier is the creditor to Tesco. True? So that's why they wrote a Tesco trade payable £1,000 or £2,000. So Tesco owes the supplier £1,000, and this is why it's considered to be a liability, yeah, because obligations on the business to pay the money back to the supplier. The opposite way, trade receivables is considered to be an asset. Why is an asset? Because the business maybe doesn't physically own the £1,000, but they will receive it, isn't it? And that's why it's considered to be an asset. And that's the main difference between trade receivable and trade payable. Trade receivable, we call it, is debtor, and trade payable, creditor. So some terms to understand is the capital. Capital is the owner's investment of the business, right? If you got money, £10,000, and you need to start your own business, this is the capital. This is your capital. Withdrawals, or we call it drawings, when the business, if you have a business and you want to withdraw £10,000 from your business for personal use, you want to buy your BMW car, so you withdraw this money, but this is for personal use, and this is why we call it withdrawals. Again, if we review what we did say, right, very simple. When you increase your assets, remember that your equity increase, right? So remember this. But remember always, there are two sides here. If something increase, will increase. If something decrease, could be decrease. If something increase, could be decrease. Decrease, increase. It has to be two sides here. This is what we call it. The equation is in balance, and this is what we call it the double entry booking system, and that will come to it in a bit. So the first statement we covered is a statement of financial position, or we call it the balance sheet. Now let's come to the second statement. The second statement is called a statement of a profit or loss, or income statement. This statement measures the profitability of the business, if the business is making a profit or is making a loss. So have a look. If we start here, right, we can see that we start with sales minus cost of sales, and cost of sales is the formula for cost of sale is opening inventory or stock plus purchases minus closing inventory. So that will come to 180,656. So now, as you see, if you subtract sales from cost of sales, that will come to gross profit. Gross profit. Now, gross profit, if you minus all the expenses available, because we did say this statement shows the profitability of the business, right? So we need to show the sales, and also we need to show the expenses. So what we have expenses here, we have examples, expenses here, salaries, heat, rent, motor expenses, whatever. If you add them all together, 56,192. And if you subtract now gross profit minus the total expenses, that comes to operating profit, or we call it profit before interest and tax. If you minus interest payable, what do I mean by interest payable? Interest payable is the interest the business paid to the bank because of the loans. Because remember, when the business borrow a loan, they take a loan from a bank. Remember, they need to pay back the loan itself, but also they need to pay back the interest. And this is exactly how the bank is making the profit. So if you minus the interest, that comes to profit before tax. And at the end, if you minus the tax, that you will end up with something called net profit or profit for the year. This is a typical old version of statement profit or loss. Let's come to some terms you need to understand, and the first one is sales revenue, and I did explain it. What do I mean by sales revenue here? So these are the money, the income the business is making by selling goods or services to customers. Expenses, I did mention about its daily expenses. This is the aim of it to run the business, and these expenses are examples such as salaries, rent, electricity, etc., etc. And these expenses are incurred in running a business, as I mentioned. Also, we have two terms, you need to know them. The first one we call the return in or sales return, and the return out purchase return. So what is the main difference between these two terms? Right, if you look at the first one, the sales return. Sales return means that Apple sold you a laptop, okay, and after that you didn't like it and you returned it back to Apple. This is called sales return. Return in the laptop into Apple. That's called sales return. Okay? If there's a sales return, what Apple does need to do, they need to subtract it from sales. The opposite is the purchase return. The purchase return or return out when Tesco bought banana from the supplier, so the banana was out of date. So what happened? Tesco returned the banana to the supplier. So that's called purchase return. That's called purchase return. So purchases are made, but some goods are then sent back. That's called purchase return. So it's a purchase return to Tesco, right? But for the supplier is what? Is the sales return. So again, if it was purchase return, we need to subtract it from purchases. I hope that is clear. Now, let's come to the business transaction. If you listen to my lecture last week, we did mention, or we did explain briefly, the accounting transaction. If you remember the Tesco's example, when the Tesco's cash goes up and the sales goes up. This is called, the business transaction can be analyzed by using a double entry accounting system. So now remember, yes, Tesco's cash goes up and Tesco's sales goes up. Great. But now the question is, how can you record this transaction? What is the way to record this transaction? This is why we use something called double entry accounting system, which recognizes the different side of the business transaction as debits and credits. Let's have a look. The double entry accounting system, as I mentioned, we have two sides here. We have debit and we have a credit. So remember, on the left side, it's always the debit side, and the right side always the credit side, remember. But there is something you need to understand. Debit doesn't mean debt, or doesn't mean minus, yeah? Credit doesn't mean gain or plus. Remember, these only terms you need to use. Right. Now I did mention that this is the way we need to record the transaction. So debit on the left side and a credit would be on the right side. And that's the way you need to open a T account. It's called T account. Okay? Now, the question you need to ask yourself now, okay, debit and credit. But now the question you need to ask, okay, how do I know which one is debit and which one is credit? How do I know if an increase in assets could be debit or should be credit? So there are some rules, you need to memorize them and you need to practice them. This is the way you need to remember. Let's start. Anything increase in asset should be recorded on the debit side. Okay? Anything does increase the assets of the business, we recorded on the debit side, such as buy a car. If you buy a car, what happened? You have a car. The business has a car. This means what? The fixed assets will go up. In this case, should be recorded on the debit side. If you put money in the bank, what happened in the bank? What happened in the cash? Will go up. Again, that should be recorded in the debit side because money in it is increase in the asset side. Right. How about any decrease in the asset should be the opposite way, which is in the credit side, yeah? So an example could be take money out of the bank, yeah? If the business take money out of the bank, this means what happened? So the assets will go down and should be recorded on the credit side. So this is the first rule you need to remember, guys, yeah? Anything increase in the assets, debit side. Anything decrease the assets on the credit side. Second rule is the expenses. All the expenses, any type of expenses you have in the transaction should be recorded on the debit side. And expenses such as rent, electricity, wages, purchases, petrol, etc. The opposite of expenses, income, sales. So should be recorded on the credit side. Any type of income, any type of sales should be recorded on the credit side. And remember, opposite of sales is purchases. All the purchases, as I mentioned, and all the expenses should be recorded on the debit side. So, rule number 3. So drawings. Drawings, always remember you need to record it on the debit side. All the time. This is money taken out by the owner, if you remember. Capital should always recorded on the credit side. All the time should be recorded on the credit side. Now let's come to liabilities now. Liabilities is opposite assets. Remember, if you know rule number 1, you should be able to know rule number 4. True? Yeah. Increase an asset should be recorded on the debit side. So this means decrease in liability should be recorded in the debit side, opposite of each other. So when you say decrease in liability, right, what do I mean by this? Very simple. Decrease in liability, you something decrease the liability. How can you decrease the liability? An example, pay creditor. Yeah, did you remember when we said Tesco bought bananas from a supplier on credit? So Tesco owes the supplier £1,000, right? But now if Tesco pays the money back to the supplier, this means the Tesco decrease its liability, and that should be recorded on the debit side. Now, opposite, of course, would be increase in liability should be recorded on the credit side, and increase in liability should be taken a loan. So if Tesco takes a loan from Lloyds, this means that the liability of Tesco goes up, and that should be recorded on the credit side. As I mentioned, guys, I know it's a bit confusing. Now your mind like this, it's fine. Don't worry, guys. The only way you get it right, the practice. You need to practice a lot, so you will be fine with this. Trust me. So, some rules you need to remember that makes your life easier. The first one, for cash and bank account only. That only applies for cash and bank account. Only cash and bank account. Remember this. So when I say cash, you need to treat cash and bank account is the same. Remember this. Any money in should be recorded in the debit side. No way. Anything money in comes to the business should be recorded on the debit side. Any money out should be recorded on the credit side. But again, I'm talking about related to cash and bank. Okay, remember this. Okie dokie. Now, how to analyze the business transaction? So now you need to remember something very important. In order to decide which side is debit and which side is a credit, you need to analyze the business transaction. When you analyze the business transaction, you need, of course, to apply the rules of debit and credit, and also you need to complete the T account. So let's have a look at this example. On April 1st, okay, Emily took £25,000 from personal savings and deposited that amount to open her business. So Emily, she set up her own business. So remember, she deposited the money from her personal saving, right? So if we talk in terms of Emily's business view, what happened in the cash? Business cash goes up by £25,000 because the business received cash by £25,000. So cash goes up by £25,000. And this means assets goes up by £25,000. On the debit side, isn't it? Because we said assets goes up on the debit side. So cash will be debit. Now, the first transaction, she started her own business, right? If she started her own business, this means the capital is involved. Yeah? So if you go back to the rules, debit and credit rules, you know that capital should be recorded on the credit side by £25,000. So can you see, this is the transaction. Cash, debit, capital is credit. So again, there are two things you need to remember, right? The first thing, one side should be debit and the other side should be credit. It has to be two sides, and one side must be debit and the other must be credit. So if you ask me now, Okay, how about Emily, the £25,000 from her own pocket? I don't care. I don't care. What I care about the business. Remember something. Emily and her business are two separate identities. And this is one of the accounting principles here. The assumption that is a separate entity means that you treat the business separate from the owner. Okay? What does that mean? This means that Emily's business, right? Look, Emily's business owes Emily £25,000. Can you imagine? So we treat Emily's business as a person, right? So the business needs to pay back to Emily £25,000. This is why capital is considered to be liability. Right. Let's have a look at exercise 1 then. Adam just gone into business following a list of transactions for the month of September. Let's start with the first one. So you need now to decide to tell me debit, credit, cash paid into the business by Adam. What do you think? Cash paid into the business by Adam. So again, of course, it's cash debit because cash goes up, business cash goes up, and of course the capital would be credit because he just started the business. The same example as Emily. How about the second one? Goods for resale purchased on cash terms. Goods for resale purchased on cash terms. So now Adam purchased goods. When I say goods, remember, always purchases. You need to write purchases. Goods is classified as purchases, and when the business buys goods, means that that this is the goods for resale, and this is why we call it purchases. But if Adam have bought computer or laptop or cars, we don't consider or classify them as purchases. So only goods are classified as purchases. So of course purchases, if you go back to the rules, you will see that purchases are on debit side recorded, yes? See? Yes. So on the credit side, should be what? Should be cash. Why cash? Because the cash goes down. Yeah? Why the cash goes down? Because Adam bought the goods on cash basis. So this means the assets goes down, the cash goes down, and should be recorded on the credit side. Is money out, and we did say money out should be recorded on the credit side. Van bought for cash. Can you see now? Don't tell me we need to write purchases. Why? Because it is a van, and we did say only you write purchases if it's only goods. So in this case, van is classified as fixed assets, yeah, non-current assets. So in this case, he bought a van, so the fixed asset goes up. That should be in the debit side, isn't it? And how did he pay for it? Is by cash. In this case, is the money out, and money out should be on the credit side, cash. So van debit and cash is credit. Office expenses paid in cash. So now remember, now we talk about expenses, and if you go back to the rule, you need to know that all the expenses should be recorded on the debit side, and of course the money out, because he bought he paid for this expenses by cash. In this case, money out should be recorded on the credit side. So if you see now, the office expenses should be debit side, and the credit side should be the cash. How about this one? Check received from customers from sale of goods on cash terms. Yeah, so now we talk about money received from customers, right, from the goods we sold on cash terms. Again, that bank goes up because it's money in, and of course our credit, our sales goes on the credit side, because we did say all the income and sales should be on the credit side. So remember something, if the transaction mentioned cash or bank or check, so treat them the same. It's fine. You can treat them bank or cash is the same. So they are both the same. Okay. Right. Okay. We move to this example in mistake. Yeah. Okay. We move to exercise 2 in mistake. So we should have done exercise 1 because we reached at the van, isn't it? Yeah. D, 1/4's rent for premises paid in cash. Again, rent, expenses should be debit side, and the cash should be on the credit side because it's money out. How about E? Some goods sold on cash terms. Some goods sold on cash terms. So again, we sold goods. If we sold goods, this means, first of all, we have cash, money in, and money in should be recorded on the debit side, if you remember. And all sales, if you remember, income should be recorded on the credit side. So if you see here, you will see that cash, debit side, and credit side sales. This one, the last one, Adam buys some office machinery for cash. So what do you think of office machinery? Is it an expense or a fixed assets? Of course a fixed assets, it's machinery, isn't it? It's not expenses, office expenses. In this case, if he bought this machinery, office machinery, this means what? Fixed assets goes up, isn't it? That should be recorded on the debit side. And how did he pay for it? By cash. So in this case, cash should be recorded on the credit side because it's money out. This is exercise 1. Exercise 2 for transaction for Muhammad. So we did do the D and E in mistake. But let's start with the first one. Transfer of cash to a bank. So what he did, Muhammad, he did a transfer money from cash to a bank, right? So in this case, bank up and cash down. Bank, if up, should be debit because money in, and cash if down should be credit because it's money out. Cash received from sale of goods. Again, Muhammad sold goods sell goods for cash basis. So in this case, so you will expect this money in because he received cash, and also would be the credit side, the sales, because we did say, if you go back to the rules, always sales should be recorded on the credit side. Okay, we did mention, I think, about, if I wasn't wrong, we did D, yeah, we did no, B, D, E, yeah. Let's go to C. Now what happened in C? He purchased goods paid for by check. If you remember, the goods you classified as what, guys? As a bank. You remember this as bank, and in this case, how did he pay? By bank. So bank should be on the credit side. So D and E, we did it. The last one is F, a motor car for use in the business paid for by check. So he bought a motor car, and if you remember, motor car is classified as a fixed asset. So fixed asset goes up on the credit side, on the debit side. And how did he pay for it? Cash or bank should be on the credit side because money out. So it's a bit confusing, I know, don't worry, but as I mentioned, the only way to know it is the only to practice it, and that's all.